Hello and welcome to Livewire Markets. My name is Chris Conway. On today's Views from the Top, I'm sitting down with Jay Sivapalan. Jay is the head of Australian fixed interest at Janus Henderson Investors. Jay, thanks so much for sitting down with Livewire.
Very good to join you, Chris.
A big part of the reason why we're sitting down, Jay, is that the fund that you manage, the Janus Henderson Australian Fixed Interest Fund, is celebrating its 30th birthday. You've been in the industry since '98, so almost as long as the fund has been in existence, and with Janus Henderson for 23 years. There's a lot to unpack in all of that, but what have been some of the most important lessons that you've learned over the journey?
One of the things that we've learned along the journey is understanding market psychology. We all come from pretty technical backgrounds. So for my part, I had an actuarial background, and many in my team have computer science or accounting background. But it's that undue influence that psychological factors can have in markets. So it's really market psychology that we've had to learn along the journey. Now, of course, there are always corrections and crises in markets, and so we need to, as investors, be ready to pivot and be quite nimble. And I guess the final thing is, to keep it simple for our clients. Ultimately, we're managing defensive portfolios. I remember, when I was growing up, I used to play a lot of Monopoly, and Monopoly is all about just collecting income. And it's funny when you look back, you sort of naturally fall into this asset class.
It's funny you should make that reference, Jay. I was playing Monopoly with my sons on a recent holiday in Queensland thinking this is how you become a fund manager. So there you go. It is pretty rare for a fund to endure for 30 years. What would you attribute that to?
Yeah. So I think for us, we do understand that the role that we play for clients' portfolios, it's a defensive asset class. So for us, it has been really important to be true to label. And then a clear and consistent investment philosophy. I was actually looking the other day at a document that we have, a presentation material from 25 years ago, and pretty much word for word, we still use the same language and the same philosophy that we did 25 years ago. And probably the next part, Chris, is to articulate to clients what to expect, not just of the asset class, but of the products. And we, of course, are an active manager. So what does that mean in a crisis? How do we navigate through that? So there are no, surprises. And probably the final thing that I'll just share is that it is important to take risks, well-considered, appropriate risks in the context of a defensive portfolio. So I remember, going through the pandemic, and we clearly were in very unique circumstances. We were having a discussion with Qantas. They were in a very dark time at the time. So we wanted security for our investors. And I remember reaching out and saying with our team to Qantas, how about we get security over your planes? Now, of course, once we thought through all of it and we thought, what if they actually delivered the planes? Where would we park them all? Fortunately, one of our team members, she actually lives on a farm. So we said, if we got Qantas, that's where the planes will be parked.
Very good. Jay, let's talk markets right now. It has been quite a volatile period, as you would well know, for fixed interest over the last few years. Where are we in the cycle? And based on your many years of experience, what do you think happens next?
Yeah, we're definitely in a quite a mature phase of the economic cycle. So global growth is slowing by design, by the intention of central banks. And yes, there are some similarities with past cycles in the sense that policy is working as it should and as we expect. But there are also some pretty key differences. We hadn't seen an inflation pulse like what we went through in the last couple of years since the late 70s and early 80s. So that's different. The pandemic itself is quite unique and very different. And then, of course, everything we talk about in terms of global trade and how the US interacts with China and so on is very different again. So I guess in terms of thinking about what's next, we do expect the economy to slow both domestically and globally. That naturally will slow consumption. It will slacken up the labour market, or make it a bit easier to access labour. And then on the corporate side, we will start to see some moderate defaults and a default cycle starting to form. So from our perspective, and when we think about markets, we don't think of markets as irrationally priced, but possibly a little bit complacent.
Jay, let's zoom in on the conditions here in Australia. Lots of talk, even on the Livewire platform, zombie apocalypses, recession, the big emotive stuff. You highlighted an article that you wrote recently that watching the labour market and not inflation will be most important. Why is that the case? Can you just take us through that thesis? And how does that plug into that broader general assessment of macro conditions in Australia?
Yeah, I think this is where the context of where we are in the cycle is really important. So, the economy is slowing by design, and I think I'd really emphasise by design. So inflation is slowing all around the world. Australia is a little bit unique in that we were later to come out of the pandemic. We're going to be later with dealing with our inflation challenges, but nevertheless, many central banks have already started that easing cycle and will be no different. Now, for us, inflation was really a 2022, 2023 story. What we really need to be focusing on from here on is the labour market. And the forward indicators are definitely showing pockets of weakness, policy working. In terms of credit markets, we think they're behaving as expected, and there will be pockets of vulnerability. In terms of a zombie calamity, that's probably not in our expectation, albeit we do expect defaults in certain industries and certain sectors that are quite cyclical.
Jay, so much time and energy these days is spent on trying to predict the path of interest rates. It's almost a national pastime. It would be remiss of me not to ask you for your view, but as an extension of that, do investors sometimes overcook the importance of these 25 basis point moves?
Yeah, it's interesting that you say that. Certainly the heightened focus on what the RBA or the ECB or the Fed might do next month or next 3 months, probably there's a bit too much focus on that. What's really important for fixed interest investors and what ultimately drives returns for our clients is more the total quantum and direction of travel of cash rate settings as opposed to which month that they might be cutting or raising rates. So when we think about that, in the context of what's going on at the moment, globally, we've had the ECB cut rates, the US Fed will be very shortly, Bank of Canada has, New Zealand across the ditch has, and a number of the other European central banks or individual country central banks have. For us here in Australia, sometime in the next 6 to 9 months is when we expect the RBA to enter an easing policy. But as I said, it's less so about the exact month, but more important what that easing policy looks like. Is it 100 basis points of easing? Is it 200 basis points of easing? And I think what we'll find is that as the labour market deteriorates, the Reserve Bank's own rhetoric will change very quickly from really focusing on inflation, which that's all they talk about today, to something very different.
Just on that, Jay, follow-up question, if I may. Are you expecting that when we do see rate cuts here in Australia, it will be potentially a more shallow cycle, a shallow rate cutting cycle than maybe the market expects? Is that your base case? And if not, what is the base case, I guess?
Yeah, so it's quite unique at the moment in that most markets around the world are expecting a decent cutting cycle. We're talking in the order of 150 to 250 basis points. In Australia, markets are only expecting a shallow rate cutting cycle at any given time between 50 and 100 basis points. We actually think that once the RBA gets going, it may turn out to be a bit more than that. Right. But I guess just to put that in context, we are talking about a policy design slowdown, an economic slowdown, not a recession, and then we'll see what happens on the other side.
Let's focus on the default risks now, Jay. Again, it's something that you've talked about in recent commentary and them being more nuanced in this cycle. What does that look like? And then how do you go about avoiding some of those disproportionately vulnerable segments of the market as you've spoken about?
Yeah, why this cycle's nuanced is if you look at the big end of town, the very large corporates, the high credit quality corporates, prior to the pandemic, they were making what I'll describe as average profits. And then through the pandemic, we would say that they moved to making super profits or abnormally high profits. They were the biggest beneficiaries of macro and fiscal policy initiatives. They got market share. Inflation was actually quite kind to them. They were able to get revenue growth, market share growth, and margin expansion. And so now they're moderating from those really high levels of profitability. They also termed out their debt, quite a bit at very low rates during the pandemic. If you look at the other end of town, the consumer cyclical, the highly leveraged, and the SME sector, the small to medium enterprise sector, they muddled through the pandemic period, and they've come out on this side, faring a bit worse than the large end of town, and that's where the vulnerabilities sit. So when we think about defaults and default cycles, that's where we're seeing the vulnerabilities. So globally, if you think about high yield, for example, there's default rates at the moment about 4%. In loans or leverage loans, about 6%. As you know, many of the stories here in the SME sector are doing it pretty tough in Australia by policy design because consumers are pulled back and the cost of money has become more expensive. So last year, the focus was very much around our residential construction and property development area. Now, I suspect that the peak of that crisis has passed, but the data will still keep showing it this year and next year.
Yep.
What we're dealing with today is hospitality, consumer discretionary, domestic tourism, recreational goods and services, and that will now show up in data next year and the year after in terms of company insolvencies. So they're probably the areas that we would be quite cautious about,
yep.
And then take bigger positions in those stronger areas that we discussed.
Jay, you wrote recently, I just want to make sure I get this quote right, that you believe that things are going to get very interesting again for fixed interest investors, and it's time to get focused, active, and get portfolio positions in shape. One element of that is being prepared to add risk swiftly and using a total return approach encompassing move, roll, and carry. Just for the uninitiated, can you just talk us through that and what that means in real terms?
You know, fixed interest is in many ways a complex asset class behind the scenes. So the easy way most investors can get their heads around it is to look at the yield. Now, the yield only tells a part of the story of the total return of the asset class. It's a bit like, you know, in share markets, just looking at the dividend yield, it tells you a part of the story, but it doesn't tell you the whole story.
Yep.
So in fixed interest, what's also important is the movements in bond yields and movements in credit spreads, and what we call roll down the curve. So that move, roll, and carry being the yield, that gives you the total return. And so if I just go through as an active manager some of the opportunities we've had and some of the opportunities we have today, think about the airport sector during the pandemic. You know, many of those securities ended up delivering 15, 20% total returns, yet the sticker yield was only at that time 3 or 4 or 5%. Similarly, we had the same thing with the universities, you know, during the mid part of the pandemic. And then last year, you know, there was a lot of discussion about Australian REITs and the senior debt of Australian REITs. And, you know, we put out a piece which effectively said, look, we don't know the exact timing, but over the next 3 years, we think a cumulative 24% type return is quite achievable from the senior debt of REITs. And in the last 12 months, they've been about 10%. Yep. So we've already got a double-digit return, another 14 to go. Now, if you have a look at that, the actual sticker yield was only 5.5 or 6%. So the rest of the return came from that move, roll, and carry.
Jay, let's zoom in a little bit on duration. Again, you've talked about yield curve positioning mattering most just before and then during a rate cutting cycle. That's a quote. Can you explain for viewers what that means and then talk about how you're implementing that in the portfolio as it stands today?
Yeah, so every cycle is a little bit different, but there are some hallmarks that are quite similar. And so if you observe, you know, past economic slowdowns, whether it was the tech bubble in the late 90s, whether it's the WorldCom Enron period or the GFC, European sovereign crisis, and obviously the more recent pandemic, essentially what the market tends to do before an easing cycle, and the same is true on a rate hiking cycle, is that it tries to attempt to fully price in the easing cycle well before the RBA actually gets going. And so the part of the yield curve that it most impacts, so if you sort of think about bond yields falling, is that 2 to 5 year part of the curve. And in many ways, we talk a lot about duration as investors, but you can have 2 years of duration in the right part of the yield curve, and it'll be just as potent and valuable for investors in driving returns as having 5 years or 4 years duration in the wrong part of the yield curve. So right here, right now, we very much favour, and this is how we've positioned our portfolios, very much targeting that 2 to 5 year part of the yield curve. Now, once the RBA actually starts cutting rates, the next phase is actually to move that duration to 5 to 7 part of the yield curve, because that'll move next.
Jay, let's talk about the next 12 months. Let's focus on what do you think is the biggest risk? What do you think the market is underestimating? And then what potentially is the biggest opportunity on the other side of that coin?
Yeah, so I think, in many ways, the risks are gradually building in the credit sector. As I said, the high quality, larger corporate side, that's really the sweet spot for investors. We're not expecting defaults in that area. Maybe some mark-to-market volatility, but that's part of the course. But it's really that permanent loss of capital that perhaps investors are underestimating, and the recovery rates that we're actually seeing. And we can see that in pockets around the market. So that's something that we're keeping an eye on from a risk perspective. Mm-hmm. And there's ways to protect portfolios through using credit default swaps or credit protection. And certainly we've employed that in portfolios for investors. On the flip side, though, there are some great opportunities out at the moment in not too complex areas. I'll talk about our states and state government bonds. Of course, the fiscal position of our states, whether it's Victoria or New South Wales, is deteriorating, but the market has priced that in. And we've got a unique situation where potentially simple old New South Wales and Victorian state government bonds could actually outperform high yield markets over the next 12 months.
Right.
Now that's something that you probably won't get too many people talking about.
No, I've not heard anyone else talk about this,
Yeah, but it's a great opportunity, we feel. And so, we always talk about this idea of take bigger risks in safer things. And this is a part of the cycle where it makes sense to do so. The other area that I think is really exciting is what the Australian government is doing in terms of outlining its sustainable finance taxonomy over the next year. And that will really unlock some really interesting investments for bond investors and fixed interest investors, whereby perhaps part of the revenue is either guaranteed, implied, or supported by government streams. So really risk-adjusted returns should be quite good.
Jay, the format that we're participating in today is called Views from the Top. We covered it at the top of the conversation, your extensive journey and how many years you've been involved in the market. What is the one thing that you have learned over that time that you wouldn't have learned if not for the amount of time that you've spent in the industry?
I think the number one thing that when I reflect back is expect the unexpected. Right. Despite how good your analysis is, how much work you do, how much due diligence you do, and how much judgment you face, markets and the world can have a different plan for you. So it's really important to have a plan B and a plan C and a plan D and a blueprint of how to navigate crises. Crisis is part of the course, downturns are part of the course. It's about extracting the best opportunities and returns and being ready and having liquidity to take advantage of that.
Jay, thanks so much for sitting down with Livewire today.
Yeah, thank you, Chris.
If you enjoyed that interview as much as I did, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.